Today is April 13. It is 5:28 p.m. The market is closed. However, we saw some unusual options on Nvidia, and some of our subscribers have been asking about Nvidia, so we thought we would talk a little bit about it. We'll also propose a trade since we see here that the volatility is very low. It's actually so low that we don't think it could go any lower because it's at 0%. So we want to simulate a trade that we would put on if the market was opened that takes advantage of this volatility. Okay, so let's first take a look at the unusual options. They were done at 2:33 p.m. You'll see here these 2,700 of them. The April 14th, keep in mind, expires tomorrow, and then these April 21s. So we think what is happening here is these April 14, the 255 puts here. You'll see here there is these 10,000 here on this range. We think this was actually a closing order, and this is also less than the open interest. And then we think then on the April 21, 8 days away, the 252s were being opened, and you'll see here the volume is greater. So we think they were rolling, closing out the trade since it was expiring tomorrow, and buying more, kind of extending the time another week by opening this trade. Okay, so there was a rolling order that we see here. And so our trade that we would put on for something like this is actually a double diagonal. So you'll see here, this is the trade here. It's being simulated. It's 5, you could get it for 511. And what it is that it's basically two calendar spreads combined together, where we're buying the 275 calls and selling the 275 calls in the shorter term, and also buying the 260 puts in the longer term on April 28th, and selling the near term 260 puts. So what happens is that our Vega is actually very positive. It's 17, so it's very good, and we'll also have a positive theta trade. So essentially our break evens, if we take a look at it here, you could see that our break evens at expiration on April 21, it's 279 here, right here. And our lower break even point is at 257 here. Okay, so this is, keep in mind also that the 257 and 279, the high was 280. It stopped right at 280, a whole number. So if it were to come back up to this level, we would start considering to close our trade if it breaks this 280, right? So this strong resistance here. And if it goes below that 257, which is right here, which is this this shadow here of this candle on this day on March 28th, this is part of one of its lows, then we would also consider closing this trade. However, you also have to take into account that if this continues to drop, volatility will actually start to increase. So this will increase, and that will actually be good for our trades, because right now the volatility is at 0. So let's say it were to increase, the volatility was to increase 10% here. So if everything increased 10%, for example, our break evens would actually widened out. You'll see here now our break evens at expiration now is at 283. You'll see here. This is 283. And over here, our break even now is at 253. So now our range for this to be profitable has now extended more because of the volatility increase. So that's why we like this trade. This is a double diagonal trade, one of the more complex trading strategies. But it also is one of the excellent strategies to take advantage of very low volatility. Yeah, so if this was helpful and you learned something, please give us a like and consider subscribing. Helps our channel grow, where we can keep on analyzing options, and especially the unusual options activity, and letting everybody learn how to use this as part of their trading strategy. All right, well, I think we're going to call it a day today. Keep the comments going. We really appreciate it. And thank you all for participating. Take care.